So for today's session, what we're going to do is we're going to take our simple valuation model and we're going to build an enterprise discounted cash flow valuation of this hypothetical company, or an enterprise DCF as it's called. So I'm going to teach you the process, which was explained in the book. You read the chapters on how to do enterprise DCF. So we're just kind of going through that here in the process of class today. And I'm going to try and simplify this to the key elements that matter, recognizing that when we do the Bloomberg tied, more sophisticated company, real-world company model, it will be more complex and some more nuances. But here, I'm just going to focus on the kind of forest versus the trees of what's really going to matter and what's happening in the valuation. So you get a better sense of what we're trying to do here. So here's what we're going to do. Using our tabbed approach, let's just remind ourselves what we have here in the pre-midterm example. So we had a tab called Financials. And in the Financial tab, what we've done is we have historical income statements and balance sheets, which we've turned into economic statements, converted economic statements, right? And we did a series of metrics to help us understand the business. Now, what McKinsey talks about as a best practice for valuation is they say that valuation is all about future cash flows. Right? So it has nothing to do with historical cash flows. It has everything to do with the future cash flows. And that's called intrinsic value. So in a way, it's just doing a big NPV. Right? Now, here's the thing. The difference between a project NPV and a company NPV is a company we assume lasts forever and a project ends. So what makes it a little trickier to do a company than a project is we have to forecast many more periods than what we do in a project. Right? And the other thing is that we're predicting the future, which is highly uncertain. So to do a better valuation, this is the process that the book recommends. We start with historical numbers, and we turn them into historical ratios, which we've done. And what we do to create the forecast is we forecast the ratios. We don't forecast the cash flows. Right? It is much better to forecast the ratios because the forecasted ratios will create the forecasted cash flows. Right? So there's two ways to forecast. We can forecast the cash flows directly, or we can forecast the ratios. So we're going to forecast the ratios. And to help us forecast the ratios, we're going to use historical ratios, therefore the metrics that are on the screen, to help us get a better understanding of what's going on with the company so we can create more realistic ratios in the future. So the past informs the future, and that's why we look at the past. Okay, but obviously the future can be different, and we recognize there's a level of uncertainty there. So, process-wise, here's what we're going to do. We're going to start out by creating a new tab, and I'm going to create this tab and call it Ratios. I apologize, but Excel has been acting up. All right, so make it a little bit bigger. So here's what we're going to do. Again, I'm going to shortcut some things that we won't be doing. We'll be doing in more detail later, but just to help you. What matters is the future. So basically, we have historical data here, 2013 to 2015. So starting with the ratios, I'll take the future data, which is 2016. So that plus 1. And we'll do 4 years worth of forecast. Equals previous year plus 1. We'll do 4 years worth of forecast. All right, so this is my forecast. Now, here's the key. As the book says, whatever we forecast n plus 1 periods. So, if I do 4 years, what I'm doing is I'm saying the first 3 years are the year-by-year cash flows. Year 4 is what's called the terminal value or continuing value period. So whenever you do a valuation, you always forecast 1 additional year to represent continuing value. So what I'm really doing is I'm forecasting 3 years through 2018, and 2019 represents the beginning of the continuing value period. If I did 10 years, if I wanted to forecast 10 years, then I'd actually do 11 in my model. So 10 years are the first 10 years, and then year 11 is the beginning of the continuing value period. So n plus 1, whatever that plus 1, always add an extra year for continuing or terminal value. So for now, I'm just going to use a representative example of 3 years of defined forecast. Year 4, continuing value. To do enterprise DCF, what matters is the free cash flow. So what we're really trying to do is we're trying to forecast the free cash flow. So what I need to forecast are the elements of the free cash flow. So in order to forecast free cash flow, I need gross cash flow and gross investment. So what do I need to do gross cash flow? Well, I need my revenue. So what I'm going to actually care about is my revenue growth rate. That is what's going to matter to me. So what is my growth rate that I'm going to use in the future? All right. And oh, by the way, I'm going to add to this, just so I put it all on one page, make this a little bit smaller. I'm going to add to this my historical periods as well for revenue growth rate. So, for example, my historical years are 2013 through 2015. And on the metrics tab, we have the historical growth rates, revenue growth rates, which we had calculated prior to the midterm. So I'll just pull those right off of there. And that was the historical growth rates in percentages. So the company was growing at 9% and 5.4%. Right? So here's the idea. What I'm going to do in the future is, as a starting point, I'm going to assume that the past repeats itself. Eventually, we'll change these assumptions. I got to put a placeholder in there. So equals the previous year. I'm going to arbitrarily pick yellow as a color. It's kind of ugly, but here's the point. Yellow helps me identify that this is a cell that I can change. Right? Because when we build these complex models, what's going to be very important is there's certain cells that are formulas that if we change, it will break our model. So I want to highlight to myself to say, here's something I can change, and here's something I shouldn't be changing. So things that I'm allowed to change, I'm going to make yellow cells. Right? And it's just something arbitrary I'll pick this semester. You can make whatever color, as pretty as you want it, but I'm just going to use simple yellow cells because it's easier to see against black. Right? So back to this. So basically, and then equals the previous year, and then make that yellow and copy and paste this out to 2019. Okay, so it's my revenue growth. Right? Next, I need my forecast for depreciation as a percentage of sales, which right now in 2013, I can go back to my income statement. I go back to my income statement, and I have my depreciation divided by revenue. This is my depreciation as a percentage of revenue, which I'll treat as a positive number. Historically, copy, paste, copy, paste. And then for the future, I'll leave it current, copy, and paste. So that's my depreciation as a percentage of revenue. Right? And then to get my NOPLAT, I need to know what my EBIT is. So my historical EBIT margin equals my EBIT divided by revenue. That's the percentage EBIT margin historically for each of the 3 years. And I'm going to need to forecast my EBIT margin going forward. And then finally, that's going to get me my NOPLAT, which my NOPLAT as a percentage is basically going to be my EBIT times 1 minus the tax rate. So actually, take it back. Let me go ahead and put the tax rate in here. I forgot to do that. Tax rate. And right now, in the model, the historical tax rate was given to us as 30%. So we'll use 30%. And again, just run that forward. Equals previous year. Copy and paste. Copy. Paste. All right. Sorry, Excel's been giving me a lot of trouble today. All right. So then my no plat margin equals my EBIT times 1 minus the tax rate. Okay, so very quickly, I just have some formulas that create for me my gross cash flows. Now the next thing I'm going to need is gross investment. Okay, so how do I do gross investment? Well, here's how we're going to simplify it. We had originally talked about something, and there's a formula called the reinvestment rate, which is the percentage of capital reinvested. So instead of forecasting capital year by year, what we're going to do is we're going to forecast the reinvestment rate, and that will basically give us the dollars of gross investment to help us calculate the dollars of free cash flow. So what matters here on the ratios is my reinvestment rate, which again is a percentage. And right now, for the last 2 years, off of the CFI, or sorry, the metrics, was going to be negative 40%, 7%, and positive 190%. Now, I could drag this across, but that doesn't make any sense because 190% reinvestment forever, like this company would probably go bankrupt trying to do that, so that's probably not realistic. And negative 47% forever is not realistic either because you can't disinvest forever. You'll go bankrupt either way. So my reinvestment rate's typically in the perpetuity period is going to be between 0 and 100. So what I'm going to do, just take an average of the two, equals that plus this divided by 2. And I'm going to say that that's the reinvestment rate that the company will reinvest going forward. Now, when we eventually play with the model later, like we'll change these assumptions. Right? We'll do some what ifs, and as we're changing the what ifs, then it will obviously affect the valuation. But really, as I'm setting up the model, all I'm really trying to do is put in some placeholders so we can create some formulas for free cash flow. So by doing that, we've actually gotten all the pieces to put together a free cash flow of the company. All right, so let's put that together. So what I'm going to do is I'm going to create another tab. I'm going to call this my DCF valuation. Okay, and again, save as I go along. And I'll make it bigger so you can see it. All right, so I'm not going to worry about the historical data in this tab. I'm only going to worry about the forecasted data in this tab because when we do valuations, we don't care about the past. It's only the incremental cash flows of the future that are going to be part of our valuation. So what do I need? I need my gross cash flow. How do I get my gross cash flow? Well, I need my no plat dollars. Well, how do I get my no plat dollars? Sorry, skipped a cell. I add in, I need my revenue in dollars. So how do I get my revenue in dollars? Equals the 2015 revenue times 1 plus the predicted revenue growth rate for 2016. That would be my 1 plus, try this again, told you Excel's been a lot of trouble today. All right, so equals 2015 revenue times 1 plus ratios 2016 revenue growth rate. There we go. All right, so that would be my revenue dollars in 2016. For 2017 equals the previous year times 1 plus And again, same thing, whatever my revenue growth rate is in 2017 in dollars. So here's what we're setting up, and you can kind of look at this conceptually. But right now we have some placeholders. What if, save this, what if I thought instead of 5.4%, the business was going to grow at 8% a year? Well, then my model then forecasts out 8% revenue growth versus 5.4% revenue growth. Okay, so that's why we're putting in placeholders. Eventually, we'll put in our own analytics and come up with what the numbers should be. But for now, we're just setting up the structure to get the model to work. So I'm going to go back to the 5.4. Everybody with me so far? Okay, continuing on. Yes?
How do you get to 2017?
So 2017 is just 2016 times 1 plus the 2017 growth rate. And I just copy that across. All right. What are my dollars of no plat? Well, I could do it a couple different ways, but one of the things I'm also going to need, and I'll put it on this page as well, so you can see the granularity here, is that's going to come from the depreciation in dollars, and it's going to come from the EBIT in dollars. So in 2016, if that's my revenue, then I'm going to take that forecasted revenue times from my ratios, my 2016 depreciation rate. So that's how many dollars of depreciation I'm going to have each of the years. All right? EBIT equals my EBIT margin. Do the other way. Times 2016 revenue. Okay? So, and again, copy that going forward. So what is my no plat? Equals my EBIT times 1 minus the tax rate for each of the forecasted years. That is my no plat in dollars. Copy, paste. So what I'm really trying to get to, my gross cash flow. My gross cash flow is my no plat plus my depreciation. That is my gross cash flow in dollars. Questions about what I just did? All right. Finally, to get the free cash flow, I need to know what my gross investment is. So here's the point of the 414.24. If I reinvest 71.8%, I would reinvest 297.45, which would get me free cash flow of 414 minus the 297, which give me 116.79 in free cash flow. So those ratios on the previous tab basically get me these free cash flows. Yes?
Where do you get the gross investment from?
I took the gross cash flow, and to get the gross investment, I multiplied by the forecasted reinvestment rate. Because the whole point of reinvestment is what percentage of my gross cash flow am I reinvesting back into the business. So that's what I'm saying. I don't have to forecast CapEx and working capital. I'm kind of combining them into the reinvestment rate, and I'm using a proxy for both. That's the reinvestment rate. That's the percentage of the gross cash flow that we're putting back into the business. What's left is our free cash flow available to pay out and distribute. Other questions? Okay, so we got to present value this. So back to our free cash flow. I need to present value these free cash flows, which means I need a discount rate. I need an R. And so we're going to use the WACC as our discount rate. All right. Now, with Enterprise DCF, it's the same WACC for every year. So right now, the WACC that was given to us as an assumption to use was 6%. So I'll put in 6%. All right. So my discounted free cash flow equals cash flow divided by 1 plus R to the n. So that is my discounted free cash flow for year 1. Now when I copy and paste this over, I want to make an absolute reference to my WACC, so I'll make it $B, $13. So therefore, copy and paste that over. And present value equals cash flow divided by 1 plus R equals cash flow divided by 1 plus R squared equals cash flow divided by 1 plus R to the third power equals cash flow divided by 1 plus R to the fourth power. Okay, so again, just time value of money, present valuing those cash flows. So those are my discounted cash flows for each of the 4 years, assuming that WACC. Everybody with me so far? Okay, so this is all operating value is. Operating value says take the first 3 years, which is in this case is the defined period where we're forecasting year by year of the free cash flow. And what I'm going to do is I'm going to sum them up. So basically equals this plus this plus this. And that's the first 3 years of operating value. Okay, just the discounted free cash flows for the first 3 years. And then what I need is I need something called the continuing value, which is basically the key value driver of growing perpetuity, because the company's going to keep going on after year 3, hence year 4. So I'm going to have an undiscounted and I'm going to have a discounted continuing value using the key value drivers. All right? So let's do the undiscounted free cash flow. You did the key value drivers on the midterm when you came up with a multiple of 15. That was the key value driver equation. What the book says is that's what we use for the continuing value of a firm. So there's 4 things we need. We need the no-plat. And specifically, we need the no-plat in T plus 1 or N plus 1. Translation, we need the 2019 no-plat. All right? That's why you always forecast the extra year, because it's the first extra year that you use in the key value driver continuing value equation. So it's our 2019 no-plat. We need a G, a very long-term growth rate in the free cash flow, proxy growth in sales at constant margin for that. But the key is, what is the very 30-year growth rate in free cash flow? So one of the assumptions that is made is that a mature company will generally grow at the same rate of the economy that they're in. It's kind of a simplified assumption we make. So if this is a U.S. company, our long-term growth rate is going to be somewhere around 3%, 2 to 3%. Okay, so one of the typical assumptions is we use 3%. So what I'm going to do is I'm going to put in here a long-term G, and I'm going to call this 3%. 3%. Okay, and those are things that I can also change, so I'll make those yellow. All right, and then finally, I need an ROIC. So I need a continuing value ROIC. So again, what I'll do is I'm going to go to the EP tab and I'm going to use my 2015 ROIC as a starting point for what my ROIC will be in the future. I can obviously change that later, but that's the current ROIC of the company. And since nothing else is changing, I'm just going to keep the ROIC constant going forward for now as a placeholder. Okay, so I now have the key value driver pieces. This was the formula from the midterm. Equals no-plat. So 2019 no-plat times 1 minus the long-term growth rate, the G, divided by the continuing value ROIC, divided by the WACC minus the G. That is the long-term value of the firm into perpetuity, from year 4, 2019, into perpetuity, using the key value driver formula and those assumptions. But that's the value as of the beginning of year 4, and I still need to present value it to today. That's why I have the undiscounted and discounted. So I still have to discount this to today. So basically, the discounting it today says take that, divide by 1 plus the R to the third power. Don't make the double discounting mistake, meaning 2019 has already been discounted by the growing perpetuity. So you don't have to rediscount that year. You only have to bring it back 3 additional years to get it back to present value. That's just Finance 101. Questions about that? Because what we've basically said is therefore the operating value of this firm is the first 3 years and the continuing value, 1749.97. That's the value of this firm from its free cash flow by running its operations, assuming those ratios come true. Questions? Pretty straightforward? Okay, so Modigliani-Miller. Operating plus what equals enterprise value? What do we have to add to this? Non-operating. So we need our non-operating assets and liabilities. So again, where do we find them easily? This is where TFI helps us. Because on TFI, we've identified the non-operating assets and liabilities. They're right there. Right? So here's the point. I'm just going to bring these in. TFI. I got these 3 things, starting with excess cash. And I'm going to bring these 3 things in to value them. Now again, here's another simplifying assumption. Right? Most people say that the focus of a business is not the non-operating activities. So we're going to make a simplifying assumption that non-operating values are NPV 0 long-term. Right? And here's an example. Apple's cash, right, excess cash. What they're doing is they're basically putting the excess cash into risk-free investments. Well, if I take cash and I put it risk-free, that's an NPV 0 proposition. So that's the point. The value of the asset for non-operating is the current value of the cash. That's the NPV of that. So rather than forecasting the non-operating values, what I can use today as a proxy for that is the book value. Okay, because that's the NPV 0 value of the non-operating assets, assuming cash is your primary asset. It gets a little tricky when companies invest in other companies that have different market values. But let's just do a simplifying assumption to use book value. And that behind it is the future will be NPV 0. So back to TFI. Here's the 3 2015 reported balances they have today. So with that, what is our enterprise value? Equals the operating value plus the non-operating assets minus the non-operating liabilities. That's your enterprise value. Now, what we then have to do to get shareholder value is we have to pay all the debt and non-common equity claims. Because the shareholders, the common shareholders, are the last to get paid. Again, this is where the TFI helps us. Because in the TFI, we have all of the 3 and 4 claims listed and broken out. So here's the point. Equals, and I'll go back to the TFI. I'll start out with short-term debt. And again, I'll pay off the current short-term debt, which is 2015. And I will copy and paste these down. But here's the point. I got to pay off my short-term debt. I got to pay off my long-term debt. I got to pay off the minority shareholders. I got to pay off the preferred shareholders. Whatever's left would go to the common shareholders. All this belongs to the common anyways. So basically, when I subtract those other people who have to get paid back, what's left becomes my equity value. So my forecasted equity value is my enterprise value minus the sum of those. That's the value of the firm. If I knew how many shares they had, divide by share price. Okay? In a nutshell, homework 5. The difference is you'll be doing this for the midterm company, and I will give you the assumptions that I want you to put into the future ratios. Okay, so I'll tell you what assumptions I want you to use, and use the midterm company, and that's what homework 5 is about. All right, but this is the process, and this took us a little bit around 30 minutes, and we're done. So again, it's not an overwhelming assignment, but I think it's a good stepping stone before we make it more complicated, as I said, with real-world companies tied to the Bloomberg valuation model. So that's what we'll be doing after the midterm. But questions about what we just did here? Because you're going to have to replicate this as an individual assignment this week. What do you think about that equity value? Doesn't it look kind of low? I mean, the company is not worth very much. It's $89.97. Why is the company not worth that much? Yeah. Okay. So they have a lot of debt. That's half of it. What's the other half of why they're not worth that much? It's a lot of debt relative to what? Yeah, to the enterprise value, and specifically the operating value. So let's look at the operating value. The operating value is actually less than the total debt. If you include minority shareholders and preferred as part of their debt, it's less. Why? Why isn't there much operating value? Yeah? When we built this simple model before the midterm, this company had a negative spread because it had such a low ROIC. All right? And so this is the manifestation. When you have a negative spread on your operating value, you're not going to create a lot of operating value. And when you have a negative spread, it means you don't generate enough value to pay back your shareholders and debt holders a reasonable rate of return. So that's the point. This company, which is destroying value, is really, this operating value, as somebody said, that given all the debt they have, it's really not that much relative to what they've spent on all their debt and equity. So why does this company not have a negative value? Because they have some non-operating assets, specifically 500 worth of cash. But it's the 500 worth of cash that once you pay off the debt, there's very little left over to basically pay back the investors because the operations are not worth that much because the company has a negative spread. Everybody see that? Questions about that? Because here's what I want to show you. This endeth the assignment, but watch a what if. What if the incremental spread were 15%? Notice what changes. Nothing about the first 3 years change, because those are year-by-year forecast. But the continuing value goes up dramatically from 1421 to 3675. Nothing changes about the non-operating and debt, but what changes is suddenly there's equity value. Why is there now a lot of equity value?
They have positive spread.
Exactly. So this is how the growth spread combination manifests itself into the value of a company. When a company has low spreads, the equity is not going to be worth much because basically the cash flows that are generated are going to be similar to what the cash flows invested that have to be paid back are, and people kind of break even. So this is why the negative spreads are painful to the shareholders. And I'm telling you, if the spread gets too negative, what happens when the spread gets to 0? Well, can't have it at 0 with a divide by 0. What happens when it gets to 0.5%? Now what happens? The company is bankrupt. And why is the company bankrupt? Because it lost so much money investing in bad investments that it can't pay back the debt even with its cash reserves. Does that make sense? As a matter of fact, if you really want to see this, what if I made the continuing value ROIC approximately 5%? Well, then we're pretty much worth the cash, right? And the reason why is because we essentially are worth the cash because there's no value for the business being created for the shareholders. And why is 5% the number approximately why there's no value for the shareholders and we're worth the cash? Because 5% is the cost of debt. And we talked about that also pre-midterm, right? So again, by doing it more simplistically, we're going to see the same lessons when we talk about real world companies, right? But as I said, I'm trying to keep it a little bit more simplified so that when you see what we do with the real world companies, you'll understand in a much more complex model what's actually going on. Because this is really what valuation is about, right? This is the core of what you need to understand and the why that things are actually changing that we just assessed ourselves with in the midterm. And that's why the key value drivers matter, the spread matters, the incremental investment matters, the free cash flow matters, the reinvestment rate matters. And so to be honest with you, there's about 10 things, 5 to 10 things that you really need to know as an analyst. And your real job is not the math. Your real job is to take everything the company says and distill it down to those ratios and to think about what they're likely to be in the future. That's what an analyst does. Now, to do that is obviously, and that's why we do the process. We need the EIC to help us inform what kind of growth rates, what kind of returns, what's happening with the competition, etc. Right? We need to do the historical financial analysis because we need to basically have some basis before we start predicting the future that guides us. Now, not that the future represents the past, but it gives us a starting analysis. And we're going to do multiples right after spring break because that's going to give us some real world insights of what the company's investors are willing to pay for the company, which gives us some further insights, as you'll find out, into how people are actually looking at their assumptions and their models, because at the end of the day, prices are based on assumptions, right? And that's back to the question in the midterm we talked about today, which is why the accounting doesn't matter. It's the cash flow intrinsic value. So if something changes about our assumptions that changes the cash flow intrinsic value, meaning this company is going to go from a negative to positive spread, then that's going to have a huge impact on the business. Whether or not the quarterly earnings meet a target doesn't really matter. So when you see the expectations come out, what people are doing is they're not looking at what happens in the quarter. What it's doing is it's causing them to change their fundamental view of a company long term. That's where the expectations come in. That's why earnings management is so hard, because if you make decisions for the short run, people actually do have to look at the long run, because that's where all the cash flows are coming. If you look at this simple company, everything has to do with that year 4 beyond. Nothing has really to do with the first 3 years, right? Because the value of the company right now in the first 3 years is 110 for year 1. The value in year 4 going forward is 1421 in present value, right? So the value from year 4 forward is 14 times the value of any year 1 cash flow. So that's what I'm saying. If the year 1 cash flow is up or down a little bit, it doesn't really affect the valuation of the firm. What affects the value of the firm is if we change our long-term assumptions, which then change this. So if I change my growth rate from 3% to 2%, the value of the firm goes up. Let me say that one again. If I change my growth rate from 3% to 2%, the value of the firm goes up. What? Why would that happen? Yes?
Because you're growing. when you're growing negative spread stock, you want to grow it by less.
Exactly. So when a company basically says, we're going to slash some jobs and we're going to cut back on some investments and restructure the business to basically get out of our hole, that's why stock prices actually will go up. Because what you're doing is you're avoiding spending more of those negative spread investments. That's what matters more and the impact long term than the announcement itself. And then it's a question of, do I believe you? Right? So that's the other problem is companies will say one thing and they'll do something else. So we start to get skeptical of them over time. But again, that's more advanced. This is just the math, and this is what we have to do. All right. So again, if you want to think about your next homework assignment, sometime probably late tomorrow, I'm not going to do it today, sometime late tomorrow, I'm going to post homework 5, which you'll have between late tomorrow and Friday to accomplish. And I'm giving you class time on Wednesday, so you don't have to physically show up on Wednesday. So if I know I've gotten, part of the reason I did this is there's a large percentage of you that are starting your spring breaks early. So just out of fairness. So I'm going to make it available from Tuesday through Friday. You can do it anywhere. Obviously, you don't need Bloomberg, but you just need to submit it to Elms electronically by Friday. Right? And what you're going to get is you're going to take the midterm, and I'll post the solution if you screwed it up, but I'm going to post the midterm Excel solution for your section. Every section is different. I'll post what assumptions I want you to make for the years that I'm making them. And then what you need to do is tell me what the values are and turn in your spreadsheet. Questions about that? Other than that, I will see everybody in 2 weeks. Have a very safe and happy and productive spring break outside of that. And if you have any more questions, please let myself or the TAs know.